No deal. The Wall Street Journal is reporting that the White House has rejected an offer by Turkey tying the release of Pastor Andrew Brunson to relief for a major Turkish bank, facing billions of dollars in fines. This as shots were fired outside the U.S. Embassy in the Turkish capital overnight. Joining me right now to talk more about all of this is Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, it's good to see you. Thanks so much for joining us.
Thank you, Maria.
So will Turkey eventually give in to economic pressure? What's your take on what's happening between the U.S. and Turkey and its implications?
It's a very messy situation politically. On the one hand, Turkey is trying to link various issues. The U.S. is trying to treat them separately. But in terms of what it means for the economy and markets, not much. Turkey does have issues, does have economic and financial issues. They'll get worse before they get better. But we are relatively insulated, and our markets are relatively insulated. So I wouldn't worry about it from an economic and market perspective. There are political and geopolitical aspects, but not for the economy or for markets.
Because I guess people are just worried about a contagion. I mean, when we look at, the influence that Turkey has on the Eurozone or throughout the Middle East, I mean, is there the potential for a contagion which will ultimately impact U.S. banks, Mohamed?
So there is a ranking. The first contagion is within Turkey. Technical dislocation become economic and financial problems. The second is for emerging markets, the asset class itself. It is technically fragile. The third is for European growth. But by the time you go through all this and you get to the U.S., the linkages aren't that high. I have a list of 4 known unknowns. What does it mean in terms of worries for U.S. equity investors? And Turkey is the fourth of those 4.
Okay, let's go through some of your concerns right now, Mohamed. You've been so great in terms of navigating what has been a volatile situation in the economy over the last couple of decades. Where do you see as most problematic or challenging right now?
So I think the U.S. economy is on very strong footing. Because of the labor market, we continue to create lots of jobs, and wages are going up, as you just mentioned. And because of business investment, companies now have the willingness and ability to invest more. In terms of risks, I see them mostly external. It's about the fact that Europe is slowing down, China is slowing down. It's about central banks exiting unconventional policies. But the U.S. on a standalone basis will continue to outpace other advanced economies.
Okay. And in terms of where we are with the market, do you think that it's justified where it is right now, given the backdrop in the U.S.?
Yeah, I mean, there's still some separation between valuation and fundamentals. But the good news is fundamentals are slowly validating where asset prices are. And that is a difference from where we've been in the past, where there's been an enormous gap. Look, we entered a more volatile period. Why? Because central banks are providing less liquidity. Investors should realize that they are in a more volatile phase, that they shouldn't overreact, and they should continue focusing on strong balance sheet, strong cash flow, agile business models.
Let's talk about the Trump economic impact and what you're seeing out of this administration. There's a new survey of economists out this morning, Mohamed. 7 of 10 of them said that the president's tax cuts are too stimulative because of the impact on the national debt. More than 90% said that the administration's tariff policies would actually hurt the economy. Do you agree with these numbers, Mohamed? And what do you think about what we've seen out of this administration in regards to the economy?
So 2 things. One, on deficit spending. If it had come earlier, it would have been better. But it didn't come earlier. Coming now, it will have a short-term positive growth effect. And the hope is that handoffs to long-term growth. And if that happens, Maria, we're not going to worry about the debt. On the second thing, it allows the Fed to normalize more quickly. And that's the good thing. You want the Fed to have ammunition to fight the next slowdown. In terms of trade, I think of it as in game theory. What the U.S. is doing is embarking on a tariff race that it is destined to win. And other countries are realizing this. That's why the EU has been more conciliatory. That's why Mexico and Canada, and it's just a matter of time before China also realizes that it will lose a trade war with the U.S. What it means in terms of probability, 60% we end up with still free but fairer trade. 25% is the risk of a trade war, and that would be bad. But there's a 15% of a Reagan moment. that we change the trading system in a permanently better way.
Wow. So you do think that China loses this to the U.S.? You think the U.S. comes out of this the winner in terms of this this dispute between the U.S. and China?
In relative terms, yes. As long as the U.S. is willing to incur some damage, which it is, and in any war there is a little bit of damage or a lot of damage, here there is a little bit of damage, but you win the relative race. But the important thing is that the other partner or party to the negotiation realizes this and changes track. And that's what you've seen with the European Union. That is what you've seen with Canada, and that's what you've seen with Mexico.
And we're expecting the president to announce a deal with Mexico in shorter order, and yet still people are worried about how heated things are getting. A recent study says that workers are going to take home their largest paychecks in 10 years this year, Mohamed. Do you worry that wages have begun to move, and that's going to keep the Fed raising interest rates, perhaps lead to inflation?
I don't worry. I think that's a good thing because it results in higher and more inclusive growth. It has taken a very long time for wages to respond. Look at how low the unemployment rate is. Look how many jobs have been created. Economists have expected wages to go up for quite a while, and they haven't. So it's good news that that's happening. In terms of the Fed, you know, I've been saying 3 hikes this year, not 4, and I still think we only get 1 more. More importantly, we are in the midst of a beautiful normalization of monetary policy. That means we're going back to something more normal without derailing growth and without dislocating the financial markets. And that's good for the long term, Maria.
It sounds like you're comfortable with these policies. You think that the tax policy and even the tariffs and the trade conversation will ultimately be a positive.
Yeah, and what I'd like to see is one more thing, infrastructure spending. That is critical for business investment, is critical for growth. It's important to get that. I think that you've got to focus on the risks from the outside. That is where the issues are. That's where the threats are right now, is what's happening in the rest of the world. Europe is slowing, China's slowing, and we've got to navigate through a more difficult neighborhood. Remember, you can be a good house, but you've also got to worry about the neighborhood.
Yeah, so let's talk about that for a second. I mean, Europe is slowing, China is slowing. From an investment standpoint, is the U.S. the best game in town?
It is. I've been saying this all year. The U.S. will continue to outperform, and it's going to do so because of growth being in its favor, corporate earnings being in its favor. So for now, the U.S. will continue to outperform, and these other asset classes are also technically more vulnerable, particularly in emerging markets.
All right, we will leave it there. Mohamed, always a pleasure to see you. Thanks so much.
Thank you, Maria.
Mohamed El-Erian joining us there.